Yo, welcome back to another episode of Mailbag Monday. I'm your host, Jack. I got my dad, Bill, my best friend, Dylan here. Let me say, you guys, to all you listening, our numbers for this podcast have exploded. They've been way up. All the comments, all the views. I really appreciate it. I do a shit ton of media in my career, but I don't do a shit ton of media with my dad and my best friend. So we love this podcast. It's so much fun. And the fact that you guys seem to be enjoying it, we really appreciate it. So keep subscribing, keep commenting, keep liking. It gives us energy. We're really enjoying it. You guys like seeing me fired up. And sold to the man in the blue shirt. Actually, the Bitcoin Make Money Great Again shirt. That's apolitical. That's not Make America Great Again. That's Make Money Great Again, Bitcoin. So I love getting fired up with you guys, and we appreciate all the support. Okay, we are dialing in and recording on Monday, August 12th, with a Bitcoin price at $60,370 US. That is 1,656 sats per dollar, with a market cap just shy of $1.2 trillion for the orange coin. The all-time high is $73,770. So we're about 18% down from the all-time high, which was on March 14th, about 150 days ago. There's 19.7 million Bitcoin already issued and only 1.2 million and change left to go. And we are dialing in at block height 856,474 dollar bill. The last time we heard from you, it was, is the Fed going to step in? Are we going to get emergency rate cuts? Japan and the carry trade was unwinding. That was at a Bitcoin price of 49,000. Now we're back at 60,000. The orange coin that could is back to where it was before Japan hiked rates. What is the latest with the market? How are you feeling? What's going on?
I'm feeling fine. Hopefully we said more or less the same thing that I'm going to say now. There is simply too much fragility and too much risk and too much illiquidity in this market for financial authorities to exert a whole lot of monetary discipline. So whatever their target inflation rate used to be 2%. Now we're going to call it, 3.5-ish. I love criticizing monetary authorities as much as the next trader, but I'm not sure that I would do anything differently. After all, if you do, for example, what Japan did, you just inserted yourself into an election year, which monetary authorities obviously don't want to do. Anything aggressively accommodative can easily send this market to all-time highs. I know we're off that somewhat, but the fact that of all the, in order to support the opinion that I think this is a liquidity, I think the trade is scarcity, to find a way to be short fiat. If I say short dollar, that usually means versus another currency. I don't think any of them are any good. I want to be, I think scarcity supply, I want to be long hard assets. And I support that I look across stock market, the Dow a year ago, 35.3, now 39.2 that's an 11% year over year. Gold a year ago was $1,907. Now over 2,400. That's a 28.5%. And that's a hard market to put 20% on. The Case-Shiller index is what I use for real estate. That's up a more modest 5 or 6%. Either way, three different asset classes, different supply demand fundamentals. The only thing in common, they're all priced in dollars, and they're all showing strong, close at or more than double-digit percentage gains year over year. I still think that's the trade. I know that's a broken record, but come on, in an election year like this, like I said, if I were a monetary, in a position, I would not be dogmatic about hitting my inflation target right now. I think there's too much liquidity risk and too much default risk lying around out there. So if it's priced in dollars, we're trading it from the long side. Of the scarcity arguments out there, I think it's pretty clear that Bitcoin has the strongest scarcity argument. I think it's going to be the fastest horse. I think that's why my analysis always begs the question, what would change your mind? We've been saying this for months now. What would probably the canary in the coal mine that I always look for is gold. There's plenty of it. And last time I checked, it costs less than half the 2,400, to dig it up. That's just, that is more of a pure monetary where, the Dow has different cross currents in it. Real estate has more of a demographic argument in it. Gold is just a pure monetary. It's just the striking thing about gold is that it's not fiat, right? And the fact that that is really the best traditional asset year over year just supports my argument. I think if it's priced in dollars, I'm trading it from the long side. I know that's the same thing I've been saying for months, but frankly, I hope I say it again next month, right? I mean, that means I'm on the bid. Like I said, well, I used to card trades, and if the market was on an uptrend, the traders would come back and go, well, as I've told you, if I have a purchase at the high of a day, that's by definition a loser. He goes, but if the market closed a dime higher, yeah, that means the first 9 are winners, and that's the cost. I always want to be trading with the trend. I always want to be paying a new high. And in a fiat debasement screen like this, yeah, I don't mind paying 28% year over year highs on these markets because I think they're going higher.
Yes, I agree. Especially after Japan came out and effectively apologized. For those listening, so Japan, as a reminder, they hiked rates, I think 25 basis points, which caused an unwind of what is called the carry trade, which is I'm going to borrow yen because it's free effectively for me to borrow, and I'm going to put that capital into something that yields me, whether it's Bitcoin returns or whether it's a government bond that's giving me 5%. And because Japanese started to tighten a little bit and take liquidity out of the system, that started to unwind. The US government, I think Janet Yellen had a swift meeting with the Japanese and said, are you out of your fucking mind? Apologize and say you'll never do that ever again. And they did. And they said exactly that. And they said, oh my gosh, I am so sorry. We would never hike rates in an environment that is unstable, is what they said, as if we weren't in the most stable environment. I mean, it was stable. They didn't do anything wrong, but they apologized. Do you have any thoughts on the fact that they apologized? Because it effectively means like, sorry, we'll never do that again. You're in control, Janet. What do you think about their statement?
No, I'm glad you asked me because in my whatever, like I said, what do I got? 30 plus 40 years experience watching financial markets. I have no idea. We're all in the same boat on this one, right? I'm going to hike interest rates. Now let's think about it. Now maybe I won't. I mean, like I said, the markets are in charge. That's pretty clear. The financial authorities are going to take their cues, right? If the markets start to fall apart, they are not going to exert any discipline on it. When markets are in charge, markets like to go higher. I do. I think when we know that there's not going to be any fiscal discipline, there's not going to be monetary tightening, whatever target they're aiming for price inflation, they're probably willing to let it slide a little bit, given the liquidity risks and the fact that it's an election year. So we're left to ourselves. Let markets left to themselves are going to inch higher, right? You're going to keep pushing. Like I say, across the board, you got strong gains across all asset markets. I think the story is fiat debasement, election year, monetary authorities, hands are tied. Yeah, like I said, I hope I said the same thing again at your next update because I think these markets are going higher.
Yeah, I mean, my best guess is that. So it's clear to me that the establishment hates Trump so much. And again, this is not a political podcast. So I've never voted. I don't think I am going to vote. But the current administration and the establishment, they're going to do everything they can to keep that guy out of office. That's clear to everybody on the planet. And so they told the Japanese, you're not hiking shit. Come out and apologize. And I would, but they have a problem, right? They have to let the Japanese right now, inflation's 4%. and in harder assets and in things that you actually desire to have in your life, who knows, 10%, 20%. So there is civil unrest in Japan. For those that don't know, for all of our listeners, Japan citizens are furious because inflation is running hot. The Japanese central bank tried to raise rates to accommodate the civil unrest, and America said, don't you fucking dare apologize to us now. America now has this opposite problem where you're starting to see recession metrics. Unemployment wasn't looking so good, right? Now Jerome Powell is starting to say, hey, I'm open to cutting rates. So it's almost like both of them need to drink from the hose, right? It's kind of like America needs a little bit of leash. Japan needs a little bit of leash. It almost is like the world is having a really tough time. So my best guess is the Fed is going to socialize this carry trade unwind on its own balance sheet. I would say that if things get any worse, that you would see Janet Yellen, Jerome Powell say, we're opening a swap line with the Japanese. The Japanese we're going to say, here, take all these dollars, print as many dollars as you want. You can sell those dollars, use those dollars to unwind any liquidity issues that you guys may have and to ease things. And I think that that's where you start to see a lot of the money printing. I think that assets have to go higher. Nothing can trade down until the election. I think there's like a rule, like no down days, no down weeks, no down anything until the election. I think that to me is pretty clear. That the fact that the Japanese came out and apologized is that the current regime is going to do everything they can to make sure that the S&P and everything trades higher into the election, because they can't afford Kamala to have everyone's life savings down 20% going into voting day, right?
When you say apologize, what did they say? Where did they say it? And how did they say it? Because I missed this straight up. But the Japanese apologized. Did they send it? Did they send a tweet? How did they apologize? What did they say?
No, I think the central bank came out and said, we won't raise rates when things are uncertain. So sorry. Effectively, like we're not going to touch it again. Sorry about that.
No, I'm sure one of our viewers can text in the language because they never speak that directly. They say something more opaque, like
That's where I was going. Yes, exactly.
We're monitoring the situation. Oh, well, okay, so we got your attention, and so you're sitting on your hands for a while. But they did. They effectively said it. No, I tell you, however you like doing it. I know. I'll let the listener say, what do you think is would do the headline? I got whatever 30 seconds in this elevator. Am I going to tell them Jack's story? That here's the state of monetary discipline. We tried to raise a quarter, and the markets told us about it. Or mine, that in response to an economic slowdown, your government sent $814 billion of stimulus checks in the mail. So I don't know which one communicates the point that your monetary authorities are not terribly concerned with maintaining the purchasing power of your currency. They famously have the dual mandate: keep the system liquid, protect the purchasing power. It seems like it's been the single mandate ever since the pandemic, right? After all, they're mailing out billions of dollars. They're trying to exert a quarter point of discipline, and then taking it back. I mean, pick whichever one you want to put on your poster. But yeah, the monetary authorities are going to let asset prices inflate. And I think whether it's the stock market, gold, real estate, I think you got to look to protect purchasing powers. You got to get out of fiat.
Yeah. The volatility and market concerns prompted Bank of Japan Deputy Governor, I'm going to butcher this name, Shinichi Uchida, to clarify the bank's stance, emphasizing that further rate hikes would not be pursued if market conditions remained unstable. What do you mean unstable? Your country's got 4% inflation. You've like made all of your citizens' lives unaffordable, and they're pissed. Is that stable to you? He was trying to help, and nope, it was an effective apology and said, "I'm sorry, United States." We won't ever do that again until you tell us to. But what I think is going to happen is, like I said, I think that you're going to start to see money printing. People are too focused on the price of money and as far as rates. And, there's a difference between the price, the cost of money, and the quantity of money. They could still print money. So if you look at the M2 supply, it's shot up as of last month. So they're going to be printing money, even if Powell lowers rates 50 basis points. You don't need rates at 0 to go through a highly inflationary time. I think that the Fed is going to put all of this on their own balance sheet, in my opinion, and unwind this carry trade nonsense if it gets any worse. If Japan calls Yellen and says, I've got a serious problem on my hands here, I need help. If I can't raise rates, what do you guys want me to do? I bet they socialize it on the Fed's balance sheet. That's my guess. That's what I think you'll start to see, that level of money printing, at that level of bailouts, is that as the Fed is going to have to, because at the end of the day, what are we talking about? We're talking about the sovereign debt market. Like, Dad, one of the questions I want to ask you is the long end of like.
Well, before you leave, like I said, that's your prediction on what monetary authorities are going to do when the question gets put to them. What would you do? Like, what? Hey, I'm a Bitcoiner. I'm all about accountability, and I'm going to close. I'm not going to, throw more gas on this fiat fire. I'm going to raise taxes. You'd last until the next election and you'd be gone. Debasement is kind of, like I said, almost the logical answer to get out of a level of indebtedness that you simply can't pay. There is no such thing as what we saw in Cyprus for the world's reserve currency to start haircutting, right, or restructuring. That's, like I said, I'll pull up my Bill Murray quip for what happens if the U.S. tries to haircut our debt, right? That's the end of times. That is real Old Testament fire and brim, right? I don't know how do markets open? They don't. I don't know what financial markets look like if there's a haircut on treasuries. So no, I think the only answer is debasement. Further to what you said.
Yeah. They're going to print. People should just, they're going to tell you too. But I think there's a lot of, since COVID, the printing money is lowering interest rates. Lowering interest rates means easier access to capital. Easier access to capital means inflation's on the rise, means asset prices are going to go. And there's quantitative easing, there's tightening. I think everyone is used to that, and they're not going to go that route now, because they know that would signal a bunch of civil unrest. If Powell came out and said interest rates are 0, even your high school classmate would know, oh my gosh, inflation's back. Usually what they do is they approach it with a different route. They're going to come out with some ABCD letter acronym that stands for "we're here to save everyone and protect you, and also make sure that we don't get bombed" or something, and print money. But I expect the quantity of dollars to increase, not necessarily rates to ever get back down to 0, in my opinion. But, the thing that I wanted to ask you, Dad, is the long end. So, in my opinion, I've talked about this on other podcasts, that my personal price prediction is Bitcoin goes to 250,000 to $1 million. And I'm only speculating that high because the amount of money and monetary stimulus and printing that's going to take to bail out the sovereign debt market. So the bond market's been in the worst bear market since the mid 1800s. I think central banks progressively trying to price fix everything, take the volatility out of everything, stabilize everything. They've pushed all of the risk up into the biggest financial market of all time, which is sovereign debt, which is bonds, treasuries. And now we're starting to see real weakness in the long end meaning the 10-year and higher. So lending money to the government and not getting paid back for a decade, there's no bids there. Everyone's like, why the fuck would I do that? I don't believe that you guys can keep inflation below any realistic metric. Like, for someone that's been around financial markets for a while, do you agree with any of my sentiment there that the risk now has bled all the way up to sovereign debt and treasuries and bonds, and that's the market that they're going to try and stabilize and bail out. And that being in a bear market is this cycle's crisis, effectively.
What do you call it, a bear market? I mean, are 10 years in a bear market? I don't know. I mean, it's we've seen, I mean, bear markets in treasuries, that's double digits in my opinion. Like that would really get somebody's attention. I just don't think this is the long end of the market. Does not seem at all frightening to me, like I said, other than just the general debasement of anything that's priced in dollars, and certainly a fixed income. I much prefer, a hard asset hiding place. But no, I don't. If you're, I'm not seeing the trouble on the long end of the treasury market. I think treasuries still have a safety bid in a world with this much financial uncertainty and turmoil. No, I'm not sure I'm that scared of the long end of the 10-year.
Interesting. I am.
Well, I mean, take a look at it. It's
yeah, I mean, I think that what the long end tells me is no one believes that they're going to be able, like, the debt to GDP has gotten too out of control, in my opinion. United States is almost at 130% debt to GDP, global debt to GDP over 300%, meaning, like, if you want to look at growth, like, our government's going to be able to produce the growth to pay this back without inflating the currency. Look at the population. Like, if the population's in decline, like, you can't print humans, you can't print 18-year-olds that are able to produce stuff in the economy and society and consume that stuff. So if you have an overproduction of stuff and not enough people to consume it, right? And so I think what the long end is telling me is no one's a buyer that they're going to be able to produce the level of growth to pay back the indebtedness they'd taken on. And so everyone's like, the only way I'm getting paid back in full, risk-free, is if you print the money. And if you print the money, I'm getting paid back in dollar terms, but I'm not getting paid back in purchasing power. And so no one's willing to lend the government any money over any serious duration. Like, if you look at Apollo and Tether, they're only buying short term. They're lending, they're buying 3-month bills. They're not, if you were to ask those guys, why don't you buy the 10-year? Like, fuck that. How the fuck are they going to pay me back over the decade? I mean, there's not enough, we're not making enough humans. Like, no one's having kids anymore. So I don't know. It just, I mean, that to me is the crisis, really, is like, okay, so how much are you going to have to print to make that market solvent? Right? And because you're not producing enough economic growth. And by the way, economic growth, like, think the last few hundred years of civilization has been predicated on fossil fuels, right? At the end of the day, humanity is about commercializing energy from the sun. And the better we're able to do that, the more progressive and flourishing our species are, right? So if you look around, your ability to harness and consume energy is the quality of your life. You've got an iPhone in your pocket. We're recording over the internet. You're consuming this on some internet device. You're going to call an Uber. Some Uber Eats is going to deliver your food. You're going to get on a train. You're going to get on an airplane. So it's all about consumption of energy. And so unless we're going to, like, all be powered by nuclear energy tomorrow or some crazy productivity growth, that's why the mainstream media and the government is so behind AI. Is because it's another growth story. If you go, it's just a growth story. Like, is it going to be enough growth to close 120, 130% US debt to GDP? Enough growth to close 350% global debt to GDP? No. Is AI ready for world dominance and to take us, like, reimagine what it means to be a human? No, not really. It's kind of like a marginally better Google for me right now, ChatGPT. But that's the whole game, is like, okay, where's the growth going to come from? There's not enough humans. There's not enough growth, but there's increasingly more debt. I'm not buying the 10-year. I'm not buying the long end, because the only way you're going to pay me back is by printing the currency. You print the currency, I'm paid back in dollar terms, but I lose in purchasing power terms. So why would I own a 10-year? Why wouldn't I own Bitcoin?
No, I totally agree. But this is why you would own a 10-year. I mean, I'm seeing, like I say, when I start look at the percent gains across all the asset classes, there clearly seems a trend away, a short fiat trade, but I don't see a loss of confidence. I mean, a loss of confidence would, as you say, would show up more on the long end of the curve, but the long end of the curve, is performing just as well as I can see is pretty much everything else priced in dollars. If what you're saying is you're going to lose that bid, yeah, but you got a long way to go just to get back, to where you were a few months ago. I mean, I think treasuries have pretty much, maybe less so. Obviously, gold's the standout, but treasuries are showing gains, just like everything priced in dollars is showing gains. Yeah, you're looking for the canary in the coal mine to be a loss of faith in the long end of the treasury curve. I'm looking for the canary in the coal mine to be more of gold. Market would hint to me that maybe monetary policy isn't as accommodative and the trade isn't going to be as easy. But one or the other, something. Yeah, no, I'll go with your side, because everything, like I said, Treasury says the 10-year has a long way to go before that starts looking like it's indicating a change in the monetary regime.
I don't know. We may disagree on this one. I think maybe next episode we'll dive deep and debate this one. I'm a little shocked that you're not in agreement here. I mean, no, everyone's dumping their treasuries. I mean that's the game, right? Like Jerome Powell's job.
Store gold doesn't yield anything. I got to pay to store it. If the liquidity is, if markets are going to give you a hint that the liquidity trade is over, why wouldn't gold go first before the long end of the curve? Or at least simultaneous with. I don't know. I just, I started giving margin calls during one of the most disappointing decades to try to get long gold. Coming off of the 70s, gold was a great trade. We started in the business in the 80s, and gold was a 10-year disappointment. So maybe it's just part of my history, but gold has no yield. You got to pay to store it. Treasuries seems, like an easier place to hide during a monetary debasement. And if I were going to, look for some type of cue that the liquidity trade is over, yeah, I'd look at gold before I'd look at treasuries, but maybe either way.
Yeah. Well, I mean, I don't know. We can discuss this more in depth next episode, but I do think too that Jerome Powell, in theory, he acts independently. Rates should probably go much higher than they are now because inflation target hasn't been hit. But in reality, his job is to keep an orderly market in treasuries, right? His job is to make sure that the government spending can be financed, and his job is not to actually hit inflation targets and run an orderly economy predicated on the dollar.
Well, it's supposed to be both, but
say again?
It's supposed to be both.
The orderly market and treasuries part, I mean, his job is not supposed to be financing the government. That's supposed to be the Treasury's job, and the Treasury is supposed to be independent of the central bank. The central bank is supposed to be an independent private bank that has no government ties. Of course, that's not actually true. But I think in my opinion, we're already living in a fiscal dominant. So fiscal dominance is this idea that like monetary policy is fiscally dominated, is dominated by government. It's a government's fiscal policy and spending is what controls and makes decisions around our own monetary policy, which shouldn't be the case, right? Like government is not supposed to control money. In reality, though, I think we're living in that. We're not technically living in it, but I think actually Janet Yellen is Jerome Powell's boss. And in my opinion, and Jerome's job, if you look at his decision-making, when inflation became politically important, that's when he cared about inflation. And at the end of the day, though, it's just like keeping an orderly market in treasuries. If you give Japanese a swap line, it's like the only thing we can't allow anyone to do is sell their treasuries.
How do you get that job?
The
Because it's supposed to be separate from government, but how do you get that job?
I have no idea.
Federal Reserve is an appointee.
Yeah, so separate from government, but government appoints your position, right?
Mhm.
They're not separate at all.
Well-
That doesn't sound very separated to me. I'm separated from Jack. How do I keep my job at Strike? Well, he's the CEO. Well, it sounds like, there might be some connection between my job and Jack, right? So it's supposed to be non-government related, non-government, whatever, incentivized, but who hires the guy is the fucking government. So that doesn't sound very separate to me. I don't know. I'm sure him and Janet Yellen talk frequently, are aligned probably on most things. And at the end of the day, I don't think that guy operates independent of anything. I think it's all interconnected. It's all interwoven. It all has the same underlying, thesis or goal. And it's dollar dominance around the world. It's dollar dominance at all costs. It's dollar demand at all costs. Anyway, that's my 2 cents on, him, Janet Yellen, whoever the fuck is sitting in the seat of the president, and so on and so forth. But no,
Yeah.
the government hires the guy. He's not independent of the government. Sorry, that was the point that I was trying to make.
Well, I don't think anyone made a counterpoint to that. I think that that's well known. But then your takeaway is he's not going to care about inflation. What does he care about? Like, what's his job? So if his job isn't to actually act in the interest of the people and manage employment or unemployment and inflation, what is he trying to do? And I make the case that he's being tasked to bail out the sovereign debt market. That's like my whole thesis over the next 18 months or whatever, now 12 months, is that there's holes in the market. All the risk is up there. It's been pushed up all the way to the top to where Japan makes like this tiny little change. And you've had like the VIX, the most volatility since COVID or 08 is from a 25 basis point hike from a country on the other side of the world. And so I think he's going to be tasked to keep an orderly market in treasuries and try and manage all of the risk associated with the fact that this is the greatest bond bear market in 200 years. And I think we're already living in a fiscally dominant time. I do, where Janet Yellen is his boss effectively.
What does that mean? Fiscally dominant time. What does that mean?
Well, we're living in like 2 paralleled economies, right? Like, so you've got really tight monetary conditions, 5% plus interest rates from the Fed, but you've got really loose monetary policy at the government level. The government is spending egregiously. The Fed is tightening. And so you can see it in the economy. Like if your customers are really, really wealthy, high net worth vacation goers, like airlines and, vacation goer businesses, those businesses are booming. If your customers can spend a lot of money, those businesses are doing great. If you are low income, paycheck to paycheck, you're getting crushed, you're getting squeezed. You're talking about grocery inflation, you're talking about energy inflation, your electricity bill. And so the question is like, who's calling the shots? Is Jerome Powell going to say, we all have to stop spending, we have to raise rates to 15%, I'm in charge, and inflation has to get under 2%, banks have to fail, things have to correct? Or is the government in charge? And the government says, we don't actually care about 2% inflation. Let's make it 3.5% inflation. We can't afford banks to fail because then Kamala won't get elected. We can't afford the S&P to be down 20% going into an election year because everyone's life savings is in the S&P 500. We've jammed everyone's 401k. Like we've taken percentages of everyone's paycheck, whether you're employed as a janitor or whether you're employed as the head coach of the Chicago Bears, a percentage of your paycheck is plowed into the S&P 500. That cannot go down. So who's in charge? And if the government is in charge and it's the government that calls the shots, then that is fiscal dominance. That is, the government is dominating monetary policy. Jerome Powell's boss is Janet Yellen. Janet Yellen is the Treasury of the United States. And so Jerome Powell's boss and his job is effectively to finance the unlimited spending of the U.S. government. That's fiscal dominance. And so we're not technically there. Like if you Google who's Jerome Powell's boss, it's not technically Janet Yellen. But practically, if you look at like the decisions they're making, I think you can make the case that it is to support and finance government. And it's not, obviously not to, manage the inflation rate and unemployment and other economic health metrics, KPIs.
I agree.
Yeah. Well, so anyway, I mean, the takeaway as far as this episode is, listen, we told you guys last week, markets sell what they can, not what they want in times of crisis. Bitcoin is the only 24/7 available free market in the world. It's always going to react first. And by the way, it earns points every time it does that. So it goes down to 49K. Everyone's like, oh my God, Bitcoin's crashing. Bitcoin's not a hedge. Bitcoin's going to die. Before you know it, it's already back at 60K. But Bitcoin is a leading indicator. Bitcoin's a free market. Bitcoin's accessible, and it earns points when it does that. Market participants want liquidity. They want salability. They want access. And so every time people look at Bitcoin and say it didn't perform well in crisis. If you're a market participant, if you're an institution, if you're a hedge fund, if you're a government, Bitcoin overperformed in crisis. Why? Because it was available. It was saleable. It was liquid. It was accessible. And so, it depends. If you're a train goer with a Robinhood account that pretends to be an expert in things you're not, maybe you say, oh, Bitcoin didn't perform in crisis. If you're a market participant that's looking for hard assets with liquidity and salability and 24/7 free market access, Bitcoin overperformed. It was available. It was leading. It was truthful. It was free, and it corrected already. So the takeaway is don't listen to the noise. You got to stay humble and stack sats. Bitcoin is always available to sell, and markets will always sell what they can, not what they want. So there's that takeaway. And then I think next episode, we should dig into maybe the sovereign debt. I think there's a sovereign debt crisis, and maybe more on this fiscal dominance idea, because as we lead up to November, it's going to become more and more important. I'm of the opinion that nothing can go down at least until November. They just won't allow it. They will not let Kamala run against Trump with the S&P 20% off highs. I just don't believe that. And that's I think it's fiscally dominant time.
Yeah, I mean, vice versa also. I don't think monetary authorities are going to do anything are surprised to the upside either, because that would certainly help every incumbent. If they were to do something unexpectedly accommodative that would send, stock markets to all-time highs, that can't help but be a boost to all incumbents, right? People. So either way, I think markets are on their own through the election.
Agree.
Yeah, that makes sense to me. I don't know. All eyes on November, but until then, I don't know. I don't expect too much like real volatility until then.
Yeah, I mean, I'm as single issue voter as it gets. Not only obviously do I think, watch the improvements in El Salvador, watch the improvements, that can happen if, you can fix the money. Or, what? We've got, this is one of the few elections, I think we do have a chance of freeing Ross Ulbricht, right? I mean, isn't that one of the campaign play? I know everybody says campaign promises, good luck there. Yeah, read my lips, no new taxes. That didn't last very long either. But I think we have a chance of getting some attention on that, and justice as well. I mean, I'm a single issue voter for more than one reason.
I'm slightly surprised we didn't talk about this more on this episode, but when we joined last Monday, Bitcoin was what, 52K, 50K maybe, hovering somewhere around there. And I think in the last 7 days, you've had a $1 trillion asset class improve 11% in a week. Something to me. The only thing that I point to, I think you said this last week, Bill. The market seems so fucking fragile right now. Just if you sneeze in the wrong direction, it just fucking breaks. It's like blowing down a house of cards. And so if you have to sneeze, guess what? Hold your fucking nose. Don't you dare do that around my house of cards. And I just find that fascinating. I mean, you would think waking up last Monday, you're like, holy, if you weren't paying attention over the weekend, holy shit, what the fuck happened? And the answer was kind of nothing, right? Kind of nothing happened. And I think that, if, Bitcoin's a leading indicator of anything, I think 11% price appreciation in a week means that whatever happened last week was not, wasn't real. And not that people didn't feel it, not that, someone lost some money, right? It wasn't me. I hold Bitcoin, but I'm up 11% this week. I don't know about the next guy, but anyway.
I think the message was pretty clear that the markets are in charge. Monetary authorities are not going to be able to exert any kind of discipline. So yeah, is that worth 11%? I'm surprised it wasn't worth twice that, right? I mean, you guys out the way. We have nobody is going to crack down on inflation a month before a contentious election like this. Nobody is going to do that if there's that much illiquidity or in the system. So you got to kind of read tea leaves. Certainly monetary authorities should have a better handle on what kind of damage they can do by tightening, but evidently not, because they tripped Silicon Valley Bank pretty quickly. So I don't know, maybe there's just so much fragility and illiquidity that they're in the same boat we are and just going to leave markets on their own, at least through the election. That's the way I see it.
Agreed.
I agree. All right. Well, like I said, thank you guys for all the support. Keep the questions coming in. Like, subscribe. And we'll dig in a little bit into the bond market, sovereign debt. We'll explain fiscal dominance because I think it's going to become increasingly more important as we lead up to November. Or not. You guys comment and be like, fuck that. I don't want to talk about that. And then we won't. But I'll prepare for that. All right, cool. Talk to you guys next week.
All right, guys.
Get long, get paid.
Get long, get paid.